Fellow traders, 'tis I, the Rumpled One, coming to you on Wednesday, March the 19th. The year's 2025. Let's talk trading. Position size with Walmal. These videos are for educational purposes only. Your results may differ from mine and different from Walmal's. And always have your risk management in place. Never lose more than you're willing to lose on any one single trade. And you can see here right on the screen, position size equals the risk divided by the stop loss. And you might wonder, why are we talking about this? Haven't we talked about this before? Are we beating a dead horse? And it's like, yes, we've talked about it before, but no, it's not a dead horse. It's a live horse. And the thing about it is that, you don't want to lose more than you're willing to lose on any one single trade because you don't want to bust out. But on the other hand, wisely and slow, they stumble who run fast. One of my favorite fortune cookie sayings. In other words, be happy taking 2, 3, 4, 5 pips at a time instead of looking for 50s and hundreds. Because at the end of the trading session, taking 2, 3, 4, 5 pips at a time, you might walk away with 20 to 50 pips. What do you think, Walmal?
Sorry about that. I was just eating my breakfast here.
Oh, I thought you were done with breakfast.
That's okay. That's okay. But, the way I look at position size, the first question's got to be how much, you say it, I say it, one of us says it, both of us say it, every single video, and that is, how much are you willing to go and lose on any particular trade, right? And the next question and this is actually should be the first question that needs to be asked, and that is, how much are you willing to lose for the day? When is it too much? When do you cry uncle? When, and that's the most important question to really answer, because that's going to determine whether you can go and play tomorrow. And the whole thing about, with FOREX or any trading really is, can I come and play again tomorrow? And, it always comes back down to, your risk management, capital preservation. It always comes down to that. And the second part of that question, though, is, let's say let's go and say that, we're sitting out here and we got an account size of $1,000. Okay. And generally speaking, or actually, let's make it a little bit higher. Let's say it's $5,000. The general thought is, on an account that size, you should be trading, I don't know, 5 micro lots. Okay, well, 0.05. That's what a lot of people would say. A lot of conservative people would say that that's what you should be trading on that. I traded in the beginning. I traded much heavier than that, but that's what the conventional wisdom would say. And it comes down to, okay, well, what if I'm sitting there and I'm trading 5 micro lots, okay, and because that's my position size, and what if have a stop loss of 1,000 pips? Now I got a problem, because I could actually wipe my account out, or at least put a serious dent into it. Or the other side of the equation, or is, and we need to go and answer this question. Just because your account can sustain a loss, let's say you go and you're in a $5,000 account, okay, and you make a decision that you're willing to sustain a loss of up to 10% for the day, so that's $500. Can you really sustain $500? Well, you have to go and lose how many times in a row before you would wipe out your account? Okay? How many days in a row would you have to lose before that account goes away? And that would be obviously 10 days. But here's the thing. When do you start crying uncle? Because, okay, it's 5,000 today. Tomorrow we start off with 4,500. Next day after that, we're starting off with 4. The day after that, it's 3,500. When does it become a psychological draw that all of a sudden, you are afraid to take a trade? Or on the other side of the coin is that, you get into a trade and I lost $500 3 days in a row. That's $1,500 I'm down for the week. I need to make up that $1,500. And then, everything on the chart screams, get out because the trade is run as far as it's going to go and it's going to come back on you. You don't. You stay in the trade. I got to make up that $1,500. Next thing you know, you now, instead of being up, let's say you're up $300. Now, instead of being up $300, you're now all of a sudden maybe down $500 again. And so we have to go and figure those things out. Where do we stand emotionally? Where do we stand in terms of actual account size? And the reality is in Forex, there's that old expression, size doesn't matter. Well, in Forex, size does matter. It really does. And you need to go and determine what that size is going to be.
Well, the thing about size, there's two sizes. We talk about size, the position size, and that is the number of lots. But the other size is the leverage.
Yeah, exactly. Because the leverage, that's the thing that you really, I think we talked about it, you and I offline talked about it. That's the thing in Forex that can really, really get you into trouble. Even on the most conservative accounts that you have, you're still going to get 50 to 1, in terms of leverage. Where do you get 50 to 1 in any other market? There isn't anything really. And then I got an ad from one particular broker yesterday or the day before yesterday, and they were offering leverages of 2,000 to 1. And it's like that's begging people. You might as well just go write a check out and mail it to them. You start going and leveraging to that level, it's going to happen. It's going to take one trade, and you're going to be gone. And it's like it's just craziness that's out there. Some of the stuff that's there, and so you're right. The leverage thing can really, really burn you up bad quick.
Well, here's the thing though. Let's think about that. Let's say you have $5,000, okay? Instead of putting it all into the account at once, let's say you put $500 in there and you use that 2,000 to 1 leverage or whatever. Now, here's the thing. If your method and your skill is so poor that you think you're going to lose 10 times in a row, you probably shouldn't be in the trading game to begin with. But I mean, it's a type of thing where if you hit once before you bust, then you walk away with a nice a nice pile. I mean, that's kind of the way I play. The few times a year, like maybe on my birthday or something, I'll go into a casino and I will play roulette. I have a strategy where if I win once, I can walk away once out of 5 spins. That's all I need to do is just hit once. And so it's almost the same thing. If you have a Forex method that you shouldn't lose 10 times in a row if you follow the rules, and you do make one of those big bets, maybe you lose once, twice, but maybe you hit it on the 3rd time or the 5th time, and then it's like, okay, now I can start over and I've even got more.
Right. I would agree with that. And of course, the challenge in all of that is that, a lot of times people will sit there and they'll go and play, and it's like we say, okay, you got, your account can sustain 10 losses in a row. Reality is you can't sustain 10 losses in a row because what's going to happen is there's always this cost of actually trading.
Right.
And the cost of actual trading it's the spread, it's commission, and in addition to that, you do have to carry a certain level in there of free margin in order to get there. So let's say let's go and say you got a $5,000 account again, and you're risking $500 per trade. The reality is you can't take 10 losses in a row, and the reason why is because your free margin is not going to be high enough to be able to take maybe trades, 7, 8, 9, and 10. They're going to prevent you from taking those trades, or at least taking those trades at those levels. So, so you got to go and protect yourself in that respect as well. But, at the same time, I agree with you. The reality is you shouldn't be losing that many times in a row anyway. It doesn't make sense. Now, where the game really gets a little bit complicated is that, you got to make sure that, I encourage people to go out there and look this up, but there's this idea of expectancy, and that is that, when I win, how many pips do I win on an average win? Okay. And how many pips do I lose on an average loss? And you got to figure out, how many times do I win as opposed to how many times I lose. I can sit there with it. I can have a positive expectancy with only winning 20% of my trades if it turns out that my winning trades, I have a very, very high pip count, and on my losing trades, I keep my losses short, and I can do very, very well. I can also do very, very well if I have a large loss pip ratio and a very, very low winning pip count. But at the same time, I win 90% of my trades or 95% of my trades. And to be honest with you, that's kind of how I trade. I win, almost every day. I win at least 80%, 85% of my trades. That gives me a lot of flexibility because of the fact that I can sit there. My losses can be bigger than my wins. It gives me a little bit more leeway room to let the trade maybe go against me a little bit. I underline, bold, italics, whatever you want to do, a little bit. And I can because once you get into this game of like, let's let it go a little bit further, a little bit further, a little bit further. You keep on doing that, then all of a sudden there's no more room to go a little bit further, and now you're in trouble, right? Now take a big substantial loss. But you need to be able to control that. And that's how I look at things anyway. Okay, I know I'm going to win 80, 85% of the time because I know I'm going to win that often. I can go and, I don't have to go and get 10 pips on a win. They always say, 2-to-1 margins, risk to reward, That means if you're going to go and risk 5 pips, you have to win 10 pips. I don't need to do that. Generally speaking, I look for 1-to-1, and that is that if I'm going to lose, if I'm going to lose 5 pips, I want to win 5 pips, and that's how I generally look at things. And I give myself, and I know that my expectancy will turn out positive on that because of the fact that I win more times than I lose, and therefore I'll be on the top side, as they say, I'll be on the top side of the road. I won't be buried in the dirt.
Yeah, hey, we're right around that H4 open on the pound here at 129.66. I'm watching it. And I had some flip-flop boxes, and I'm just watching. Could have taken about 2 or 3 flip-flop boxes for a couple of pips since we've been talking.
And that's a perfect example of what I'm talking about. Is that you can go and grab those quick little trades, grab 2, 3 pips every time, and that's how I wind up with 80%. I grab it, I grab it, I grab it, I grab it. Oh, that's when they ran away from me. That's okay.
Yeah.
I grab it, I grab it, I grab it. We're probably out of time right now.
Yeah, that's right. Once again, the fastest 15 minutes in trading is just about over. So, fellow traders, think about it, position size, and also your leverage, because it's not what you trade, it's how you trade it. So go out there and drain the banks. This is the Rumpled One, over and out.